Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
The oil market is so dependent on what happens in Iran. I don't really like that last Wednesdays, where we clearly have an oversupply. The problem is demand, and the problem with demand is China's flat as a board, which is has always been true for the US and Europe. As economies mature, their oil demand just goes flat. I guess as the second largest economy in the world, China's matured, but I think also there's an increasing, like maybe half of the cars that get delivered every year there are battery cars, so that's got to be having an impact. India, with the same population as China, is supposed to make up the difference, but as you can see, the consumption table, India's fraction. China's 16 million barrels a day. India's about 6. So dependent on the rest of Asia, Middle East, what happens is rather than oil demand drying up by 1.5 million barrels a day, it dries up by about 700,000 barrels a day. So it's about half the growth. But the industry is proficient enough, whether we're talking North America or offshore or Middle East, to continue to increase supply. So it would not be pretty at 65 WTI, which is where it was last Thursday, were it not for the Iranian situation. And you can see, again, if you look at the bottom of Exhibit B, 66 last Thursday, but the 27 strip is 62. So I think that's a better indication of that. Gas is continuing to misbehave. The problem is too much gas production in the Permian, which is where all the growth is being. 15 B's a day of increased production from 21 to 25 cattle things from associated gas Permian, and power has been flat. I mean, moved up nicely in demand. It's a lot of support. Since Trump came into office, I think what's happening is that coal plants are not being closed the way they were under the Biden administration, and that's taking the gas growth in gas and to make power is benefiting from coal plants being shut. The Trump administration will not allow coal plants to shut. Too concerned about not having sufficient dispatchable power is nuclear or coal or gas, where you can run it 7 days a week, 24 hours a day, as compared to wind or solar. Exhibit A is U.S. government revenues and expenses. We have a pretty significant lift here in excise and others, which is where the tariff revenues go. Some amount of the money that the Trump administration has collected tariffs have to be refunded. It's not just a Supreme Court decision, but now it goes to a court that I think is based here in New York that oversees trade. And so they're the ones that would decide who gets tariffs refunded to them on what schedule. I think that for the fiscal year that we're in, ending next September, I think this forecast for $500 billion, $500 billion of income from excise and others is pretty good. That would be up $240 billion from the preceding fiscal year, even with the Supreme Court decision. I think that's a pretty good estimate. State of the Union, I may have listed. I know Trump was talking about wanting a bigger defense budget, but hopefully we can get the job done with $900 billion or so. When he talks about spending $1.5 trillion on defense, I think that's rather relevant policy. The 10-year bond is down to 4%. Did get down to 4%. We had speculated in prior Wednesdays that the deficit and the possibility of a Federal Reserve chairman who wanted to reduce the balance sheet of about $6.5 trillion back down to $1.5 trillion or so might cause the long bond to continue to stay well established in the fours, maybe even get up towards 5, even though the short rate, the funds rate was being reduced. Currently, I think it's at 3.5. Probably going to come down by 25 basis point margins a couple of times during 26. So get down to 3 and spread between something close to 5 and a 3% Fed funds rate would be a pretty wide spread. But given reducing the Fed balance sheet, which seems like a very sensible, logical thing to do, and also continuing to run a reduced deficit, but still a deficit projected here of $1.5 trillion, that would result in 4% is a full 100 basis points under 5. So at least for the moment, the long-term market is, with the 10-year market, is behaving fairly well. Now that's important, or that one of the policy of the Trump administration is to try to have more people own houses rather than rent houses, and that requires getting mortgage rates down. I think mortgage rates, I don't really follow mortgage rates like Jason do, but I think they're down in like under 6%. So progress has been made there. But the lower those mortgage rates get, with the better home building go. Yes, for a second week in a row, we're on disruptions. Seems to be the theme in the equity markets. Which business is going to get disrupted by new apps from Anthropic or any of the other language models? Jason, you think we did page 1 last week, and you turned to page 2, Salesforce, ServiceNow, Snowflake, and these stocks have come off an awful lot. Is this an opportunity, or for an investor who's always wanted to own stocks like those 3, or is this a value trap, or somewhere between? What's your assessment, Jason?
I think there's definitely opportunities out there, but between ServiceNow and Salesforce, I'm hesitant in those specifically. There's a lot of companies that have been devalued that are not going to be replaced. It's just, it might be very difficult to pick them out. The Citrini research report that came out over the weekend that's been driving the market down this week is an interesting thought piece. It's written as if it was written at some point in mid-2028, I believe, is what they created there. And they paint a picture of big companies. The CIO comes in and says, why am I going to write a $500,000 check for a SaaS software product when I can spin up a team internally and create this tool myself? And it's really interesting. And then following that one example there, they write quite a lot about how a lot of workers are going to be displaced because of this specifically. If you think about that premise, they're saying instead of buying Salesforce from Salesforce specifically, a CRM from Salesforce, every company now is going to have a team of engineers creating their own internal version and maintaining it and keeping it up and supporting it for the employees. And you're duplicating all of that work that was done at Salesforce now across every one of Salesforce's customers. So potentially you're talking about more employees implementing a CRM type software than we currently have just at Salesforce today. So I don't subscribe to what that research report was saying. I don't think there's going to be all displacement among all the SaaS products because you're just going to do it all yourself and not have employees performing that work.
Somehow that happens and you miraculously get 10.2% unemployment. Those things don't add up.
Yeah. Now, that case can be made for a CRM type tool specifically.
And for certain customers, absolutely.
Mm-hmm.
there are many tools that are used very narrowly by customers that a much simpler version of said tool would be more than sufficient. And the example we keep using here is a CRM, because a CRM for us is not very complicated. We have an email list, and it's basically just a place to store our contacts. That's not very high performance by any means, and we use HubSpot, and it's a nice CRM, but it's got much more complex capabilities that, frankly, we don't need. We've talked to other people who have implementations of Salesforce that pay about 10 times what we pay. So similarly, they probably don't use all the tools that Salesforce offers. There are other businesses, though, that utilize those tools, and they are ingrained in the workflows of those businesses to the point where switching is very difficult, but also why would you switch? If you're a large company, you're making decisions as to whether to insource or outsource stuff all the time. And it's a risk decision. Would you rather have a throat to choke internally or externally? If the CRM goes down, does the CIO want to have to fess up to being his fault or somebody on his team's fault? Or would you much rather say, I negotiated this contract and we have an SLA for 99.7% uptime, and technically we're okay because we are above our SLA agreement, but I'm going to give them a hard time about it. So a software company, I think I talked about this last week, provides a lot more than just software.
And one of those services is maintaining it and having that uptime. So there's a small team of engineers on call 24/7 to maintain uptime for the thousands of customers they have, instead of a handful of people at every company doing that.
Which is why the ultimate endpoint of all this is probably just a lot more software. So then you got to say, what does that mean for Salesforce, ServiceNow, Snowflake, et cetera? There's probably going to be more competition. Probably, definitely.
Yeah.
The next thing you have to ask is, what is the right multiple to pay for a software company? And that is, at the end of the day, we care about cash flow. And most of these companies have been valued on a relative basis to other software companies as to what the market's willing to pay as a multiple of revenue, not of cash flow. And I think that reckoning is happening at the same time as all of this new competition is surfacing.
Got Salesforce down to 20 times free cash flow.
Right.
That would typically be at 35 or 40 times.
And I think actually Accenture trades for about 20 to 25 times cash flow.
Right.
And is a high quality software company, should that trade about the same? Now, you got to be careful about share-based compensation, because most of these Silicon Valley firms have very high share-based compensation, and you need to add that back. But that's why I think a floor valuation for a quality software company is that of a quality consulting firm.
We turn to page 3. We have the Meta announcement of purchasing GPUs from AMD with an option to warrant or something to acquire 10% of AMD. Equity value went up a lot, but equity value last Friday's price, like $325 million, compared to NVIDIA, $4.6 trillion. I think the other point on this page is Taiwan Semiconductor with an equity value of $1.9 trillion is maybe the choke point here, and Meta to advance their data center capacity one of their logics, they're buying AMD chips, is AMD may have some space reserved in Taiwan Semi, capacity reserved in Taiwan Semiconductor, where NVIDIA may be totally sold out. Mike and Jason, what other speculation we have about this decision by Meta to make this commitment to AMD?
That's our suspicion as well. AMD is just higher up on the priority list at Taiwan Semiconductor. deal is very interesting. Specifically, it's $100 billion of both AI chips and CPUs. And they were citing 6 gigawatts of compute. Hunt, as you said, in exchange, they're getting 10% warrants for 10% of AMD. Today, its value, that's roughly worth $35 billion. But the interesting thing is a lot of them trigger at different milestones. And the last milestone is an AMD valuation that values Meta's slice of the shares at exactly $100 billion. So the market's looking favorably upon these deals that are being done. Those terms are nearly identical to what was given to OpenAI for 10% of AMD again. So they've given away 20% of the business for collecting this slice of the AI market that they have. I just feel like history is going to not look favorably upon these decisions in the future. They're giving their chips away, and the company. If you look back at their most recent earnings call, it was really a disappointment because their GPU sales were not growing. They grew data center revenue, and they obfuscate whether that's CPU or GPU, but then it came to light that it was mostly gains in market share with data center CPU.
So zooming out from a competitive strategy perspective, Porter's famous for this 5 forces model, and I think it's fairly simple. Is the bargaining power of buyers has gone up because there's really only a handful of buyers, and it doesn't as much apply to NVIDIA because they're larger and that's the best solution. For everybody else that plays in this game, Broadcom doing XPUs, AMD, Intel, they are at the mercy of the buyers, because those buyers would all rather, their best case scenario is they would be buying NVIDIA with a 30-40% markup. That's not the reality that they're getting, and they know that they would rather try to support a third party or second party in the system.
Page 4, Jason's been very perceptive, kind of leaning towards Disney, and Disney is doing better. And Disney now has a new CEO, promoted internal person promoted. Netflix has been sinking a bit. I keep thinking that the Netflix stockholders would be better off if Paramount won Warner and Netflix went back to being more or less debt-free and simply, relying on content they generate internally rather than acquiring a lot of content with Warner. But of course, Meta's on this page. Meta seems determined to take whatever cash flow they have from that Instagram franchise they have and spend it, both R&D and effects, so that they really have no cash flow after all expenses. Across this line of 4 companies, I guess they don't really line up to try to say Meta's like Netflix or Disney. And then, of course, we have Spotify. But they're all, Netflix is getting less expensive. Disney is getting more expensive. But the company that seems to go from triumph to triumph here with no debt and cash off the balance sheet is Spotify. And I guess Spotify, more than Meta with its franchise and Disney with its content, Netflix being the largest in streaming, Spotify has a greater risk of getting disrupted by some technology or competition. Any commentary on these 4?
Let's invert that. Which one of these has the best improved opportunity as a result of AI? And Walt Disney's an interesting option there. They run these huge parks, and they're designed for humans. So humanoid robotics could be extremely efficient in those parks. They already have robots in the having been there in recent times in the Star Wars section.
They're all going to benefit.
Yeah.
You can make a case for all of them. I think I like Netflix that now that unfortunately this deal with The bidding war with Paramount's impacted them. We've always liked Netflix. We just didn't like the valuation it had. So maybe this is a good opportunity. AI gives them a lot of great opportunities for advertising that they're not exploring or exploiting yet.
But they do have competition from YouTube for sure.
Sure.
Walt Disney almost doesn't have their experience is unparalleled.
Yeah.
Meta's got the glasses, which I experienced for the first time this past weekend. And those are actually quite impressive and phenomenal. And the quality of the video is very good. We took a group sailing on Sunday, and one of the guys had them. A guy named Vitaly Katznelson. He's a value investor. We got to try him on, and he took a bunch of photos and video, and it was just really cool because he was able to. I had him driving the boat, and he had these videos of him driving the boat, and yeah, it was quite cool. And then Spotify's network effects at the end of the day, and network effects businesses, I think, are the least impacted by the ability to write code faster, which is what everybody's freaking out about the last few weeks.
All right. Healthcare. We have a price war going on between Lilly and Novo. Is this just what the doctor ordered for pharmaceutical pricing?
Yeah, yes. Because you need a prescription, but insurance is not the payer. So when you're trying to court customers that are price sensitive, you have a price war. Yeah,
That's the key. If insurance is not the payer, and somehow you got to figure out how to make this price war work in other markets.
Yeah.
Or other products.
So yeah, Novo lowered the price of their drug, and this comes on the heels of a failed study for their next formulation of this class of drugs. It didn't best Lilly's speed to weight loss, so that was a setback for them. My opinion on the whole thing is, I think we've picked the wrong measure. I don't think faster weight loss than what's already being achieved on these drugs is necessarily a healthy thing. I think we should be looking at approval based on safety primarily. Mm-hmm. We know they cause tremendous weight loss at this point.
And I'd love to see more studies on the other effects of GLP-1s.
Yeah.
Speaking of adjusting values down, UnitedHealth, based on my estimate of kind of run rate cash flow, it's down to 16 times free cash flow. This is where company really has performed awfully well over the last couple of decades. Jason's been predicting great PBMs. UnitedHealth is the biggest, I think, PBM business is really vulnerable. Just taking a large share of the gross margin in pharmaceuticals without anything like value add that they should have to have in one will charge what they charge.
Yeah, if AI can impact anything, it'd be great if Cloud Code created like an aggregated pharmaceutical purchasing system for for physicians.
But yeah, there might be half the cash flow there that I don't know. The trouble with any regulated system is it ends up being whack-a-mole. They're going to shift profits from the PBM to somewhere else, and it's going to be. They've already tried. It'll be interesting to see how it goes, but they just keep adding middlemen. And to tie it back to the State of the Union and this like anti-fraud campaign that JD Vance is going to chair. Obviously, the administration wants to tee him up for a presidential run. And they probably wouldn't be setting him up to do this unless they really know there's some easy wins, because why would he want to stick his neck out otherwise? So I think this space is incredibly for the investor.
Yeah. And something the government did that's pretty interesting is they publicly released the billing information from Medicare for some period of time and just published it so that data scientists could dig through it and potentially try to figure out where some fraud's occurring in the system. I hope it's de-identified. I don't.
Yeah, I think
I'm sure it is. It'd be a HIPAA violation.
Not the names of the providers, but yeah.
Yeah.
No, they're finding stuff.
Right.
And then one topic that Mike's really interested in is a company called Life Biosciences had an announcement where the FDA cleared a study, a Harvard study, to reprogram Yamanaka factors. So he's been hot on this topic, but it's a longevity study. In the early stages, in I believe mouse models, they have seen that you can essentially reverse aging in some organs by reprogramming these Yamanaka factors. So they're going to study it. It'll be the first study ever in humans. It's a big step.
Oh,
So trials don't happen any faster, but it does seem like we're finding really interesting things to research. And presumably that has to do with some of the work that's been done in AI. Look at these things earlier before they hit the clinic.
right. What about other healthcare news, Jason?
Other news, as it relates to Novo Nordisk, there's a whole saga with the company called Hims and Hers. They're a telehealth platform they provide a number of drugs. You speak to a physician over, I believe, over their app. They can prescribe you drugs, and then it's a mail order system. What they have been doing is compounded version of Novo Nordisk's weight loss drug. And they've been, at first, when the drug was in shortage, they used the rule where they could compound it and bypass the patent protection because the drug was in shortage. Then they started continuing that practice under the idea that they're getting the exemption because they're personalizing this medicine for the people, their customers. That occurred for quite some time. They were undercutting on price, taking market share. The last straw was they pushed it where Novo Nordisk does have a pill form of their drug. It's a very specialized way that they can deliver a peptide in pill form without your digestive tract essentially destroying it. So Hims announced that they have a drug that performs just as well. It's the same thing. It doesn't infringe on their patent delivery mechanism, and yet it never went through trials. So they pushed the envelope too far. Either at best their drug doesn't work, it was never safety tested, and it can potentially have a safety impact on customers. So that was shut down pretty quickly by the FDA. And I don't know why it took Novo Nordisk so long, but they're finally starting to enforce their patents against these guys. So the implications there is for 2 years, we allowed companies like this to just blatantly infringe on the patent protections of these drugs. And if you extend that out to any pharmaceuticals as a whole, if you're not going to protect the patents, there's no incentive to invest the billions and billions of dollars and the decade of time that it takes to bring a drug to market.
Right. This isn't a way to fix a broken system, right?
No.
It's just ignoring IP rights is not a way to fix
We won't get a new drug. Yeah. I'm glad we're seeing that be corrected.
But we also need to see some reform in the way the rest of the system works.
What do we have to be on alert for in healthcare? Hi, Jason, got a couple of minutes left here. What things that would be difficult to predict might have significant impact? I think in terms of new medicines, there's all this expectation that somehow cancer vaccines will develop after bringing on COVID vaccines so quickly. But so far, while the pharmaceutical companies are spending lots of money on cancer therapies in development through acquisition, so far the results don't seem that newsworthy. Or being closer to it. Yeah, being closer to it, Jason, Mike, do you see more going on?
This is something that took a little while for us to really unravel. The majority, at least I think the highest probability situation for cancer vaccines is that they're additive to the current corpus of cancer treatments. And Jason, correct me if I'm wrong here, since I'm going out on your limb. If you get a cancer, you may have a cancer treatment, then you will be prescribed afterwards, basically because it will statistically reduce the likelihood of remission, you'll be prescribed a cancer vaccine for that particular cancer. There is another approach, which is more the Moderna approach, where you'd have a personalized cancer vaccine. And the challenge I see with that is mainly just that you'd have a narrower indication on which that cancer, those trials would have to be run. So barring any changes to the current regulatory structure, I think the BioNTech approach makes more sense. And the data we've seen so far are very supportive of the fact that this has a high probability of becoming standard of care in the future.
Yeah, exactly. We feel it's going to be additive, lower occurrence or lower chances of reoccurrence, and potentially drives down the cost of care because you're treating patients less often. They have a longer lifespan.
Oh, and less aggressively.
Less aggressively.
Cancer treatment is very invasive, is an understatement.
Yeah. Jason, last Wednesday or the Wednesday before, you pointed to that Grail, and then I think since you pointed out to us, they had disappointing results.
Yes. Yeah, so they ran a large 3-year-long study, and the goal of the study was to, let me back up. Their Gallery test is a multi-cancer early detection test. So you give a blood sample, you look for fragments of DNA that could represent cancerous tumor DNA for a variety of different cancers. So the goal of the study was to catch it earlier in stage 1 or 2 and reduce the number of patients that are diagnosed while in stage 3 or 4. So the study failed. They didn't see a statistically significant decrease in diagnoses of stage 3 and 4. However, it seemed like the data was pointing towards that occurring in year 3. There's trade-offs you have to make when you design a study. I don't know if that's true and if the trend would have held, but Grail only had a certain amount of money, and now their prospects look perilous because they can't run another study like this. They can't afford it. You couldn't design a 5-year study that maybe gave you the data you were actually looking for because you would have run out of money before the end of it. So unfortunately, we got what we got. I still have questions unanswered. I don't know what technology they're using since they designed this test years ago. Are they using the latest sensitivity of sequencers? Could someone potentially buy that IP, use more modern technology, and generate the positive results they were looking for? Certainly the theory behind their approach is sound. Can technology perform it? And I think someday we absolutely will be able to. But you're picking up potentially very minute amounts of cancerous DNA in a blood sample. I don't know. It's needle in the haystack doesn't even sound like.
Right. We've now blown through the 7 or 8 minutes past the 30 minutes. So we will be here 7 days from now. And in the meantime, everyone be well and stay healthy. And thanks very much for listening. Take care, everyone. Bye-bye.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.